Well, a very good morning, everybody, and a warm welcome to our 2020 Thomas & Thomas Investors Masterclass. If I can make you half as excited as that crazy guy running over the Tromsø Bridge in the marathon last year, then I'll have done my job well. Today, I'm starting with a session on really what we think the global outlook is for our clients' portfolios and how that will influence our decision making in regards to our planning for you. Now, I want to just be very clear. The first thing I always say on this is there are two types of forecasters, right? There's those who don't know, and there's those who don't know they don't know. So in no way am I saying today this is definitely going to happen, but what we are asking is what on earth is happening, both with that crazy guy running across the bridge and indeed with the global position. Things are very unpredictable. That's nothing new. We thrive on that. Let's have a look and first of all see what has been going on. So before the corona crisis, when we look back last year, things were pretty rosy. Let's have a look at some headlines. Unemployment in the UK was standing at a low point at around 3.8%. The UK gross domestic product, that's GDP, which is the sort of the output for the UK, had risen by some 200 billion up to 2.21 trillion for the year. So we were in good shape. What about across the pond? Well, the US were also on about 3.8% unemployment, which was a historical low for them. They were in good shape. And yes, you can see their GDP had also risen by about $848 billion to 21.43 trillion. So things were very bright indeed globally. However, as you know, as we came towards the end of last year, in my quarterly review to you all, I actually cut back a little on risk and went a bit more defensive. Now, it wasn't because I could see the coronavirus crisis, that's quite a mouthful, coming. I would love to claim credit for that, but this was really before we heard of what had been happening in China. This was just me being a little bit cautious. The bubble looked a bit like it might burst. And so we enter a period of tough times. And where are we now a year on? Let's have a look. Well, the figures are stark. Here we go. First of all, unemployment rose in the UK to around 10% by May of this year, and that's with most people on the government furlough scheme. You've got Mr. Sunak very kindly paying the wages of a great proportion of the UK workforce. So we believe that there's going to be probably higher levels of unemployment to come. We can see the bonus scheme is in place now that Mr. Sunak has introduced very cleverly. We like this guy. He's really trying to come up with different ideas. The bonus scheme is designed to encourage employers to take a payment in turn for promising that they will keep their employees in work. Is it going to work? We don't know. Unemployment in the US rose to around 13% by the same sort of time period. The US certainly struggling. Indeed, the US economy lost around 20 million jobs across March and April this year. That's far higher than the great financial crisis levels of 2009. And it was very worrying indeed. But don't ever write the Americans off. They've lived through some 17% being wiped off their GDP in the first half of 2020. But I'm going to share with you some thoughts I've got on the US in just a minute. This is what we went through. Now, in my portfolio session, shortly later on, I'm going to be covering this greatest crash of all time, or the fastest crash of all time. But you can see here a FTSE 100 chart. As our clients will know, we tend to use the FTSE 100 as a bit of a benchmark. And the reason is it's because it's what we all hear about on the news. You can see this horrendous crash. Look at it dropping in March and April. Something had to be done. Markets are terrible at trying to sort of over-predict, and they will often over-egg it. And certainly here was a massive sell-off. Things were just crashing at terrifying levels. and something had to be done. A rescue job had to happen. So the rescue job really happened in the form of central banks stepping in. And I want to share with you 4 headlines. First of all, let's look close at home. The Bank of England. So the Bank of England have injected so far around £300 billion worth of money into the bond markets and into stock markets to try and bolster them and help to encourage confidence and liquidity in the system. The Bank of Japan has injected 740 billion yen. The European Central Bank, ECB, has injected 1.1 trillion euros. But here's the big boys, the Americans pumping $2.9 trillion US. That's according to Rathbones, who've helped us out with these numbers. Thank you, guys. They injected, not Rathbones, the US, injected around $2.9 trillion. Wow, quite a number. What that led to was a recovery of quite impressive proportions. The market rose some 24% from its collapse point in very, very quick order. However, we're still down at least 16% really on the year. So we're some way off where we were, and that's really the next stage now to come. Now I want to talk to you about something that's really on our minds, and that is the US-China trade deal. We think this is a really, really important subject to understand for our client portfolios. And what you've got here is a little cartoon that I fell in love with of Mr. Trump with his farmers behind him, his small-sized businesses and so on, all on their knees. And he's there saying, we'll bring China to its knees. Now, in fairness, America are in a real position because China are just not playing by the rules or by Western rules. And as a result, in a way to try and protect US interests, he's had to impose these tariffs, which in turn has hurt US businesses. The big news here, I think, is that this trade deal that was started at the beginning of 2020, phase 1 alone, was a deal where America cut China some concessions, they allowed them some slack, and in return China was to buy some $200 billion in US goods over a 2-year period. How's it gone so far? Not good. China have decided, instead of buying their soybeans from American farmers, which they always did do, they've started buying them all from Brazilian farmers. It's tit for tat, deliberate kind of moving around of the goalposts, and this is very concerning. Really, this is very concerning in light of what is about to happen. Here they are, folks. The nominees for the US presidential elections 2020. We've got a bit of a problem again. On the one side, we've got Mr. Trump. Love him or hate him, he's a bit like Marmite. Some of his, many of his US patriots absolutely love him to bits. They think he's protecting US interests. And then there are some who really, really don't like him. But I guess you know what you've got with him. On the other side, you've got Mr. Biden. A lot of reports around health worries, definitely older. The concern, I suppose, is will he make it through a full presidential term if he were to be elected? So from our point of view, weirdly, and this is leaving any politics aside, we would like to see Mr. Trump continue. And the reason is that we have seen under the Trump administration real loosening of regulations around US equity markets. The markets like the Trump regime, there's low levels of interference from government, and that is a good thing for our client portfolios. And honestly, that's what comes first for us. With Mr. Biden, you've got that great uncertainty, that unknown factor. At what point will he have to hand over to a vice president? What instability could that cause markets and even global politics? And so from our point of view, really we're kind of going to have to go with the contestant on the left. But will that actually happen? Now, it's all down to who is toughest on China. That's my view, and that's just my view. But the reason why I say this is that the American public really care about the China story. Let me show you. So here we've got some research put together by the Pew Research Group in the US. They are a very well-regarded research company, and they have surveyed Americans and found that 66% of Americans have an unfavourable view or opinion of China. And that is quite interesting. Now, if I take you to the bottom of that chart, you can see actually as the groups of age go up, that view of negativity gets bigger. And given that those age groups in the older areas are more likely to vote for Mr. Trump and are more likely to turn out and vote, this really does show us where the battleground is going to be fought. If Mr. Biden steps up and is aggressive towards China, we may see a Democrat victory. If, however, things carry on as they look, it could well be Mr. Trump coming back in again. Obviously, I can't speak for all the other things that are going on. Very, very difficult to call, but China is very important. However, having said all of that, that isn't really the biggest story that will affect GDP in the next, say, 10 years. The real issue here is global population. We have a major issue now where people are living longer, and we all want to live longer, so we've all got a vested interest in that. However, the issue here is that the working population is falling. Let me show you. Now, I've got here some slides which I've borrowed from Saracen. Saracen came and spoke last year at our Masterclass, and they have very kindly allowed us to use these slides. Thank you, guys. And what this shows us is projections as to what the working age populations of different countries are going to look like in the future. Now, we can see here Japan, the UK, Europe, China, United States, the world average, and the least developed countries. And the trend is a downward one. But can I take you to that red line, which is the world line? And here you can see a definite fall and a projected further fall. That's the average. But look at that green line. There's China. Now, take it back some time ago, back to the beginning of the millennium. They were in great shape. They had a very, very large working age population. That has fallen dramatically, and it may show why some of this protectionism is starting to kick in, because look at their projected age range. It's due to fall and fall as more and more Chinese population live longer, so they lose their GDP productivity. Japan, look, the same story in the past, very high levels, falling. Now, a little bit of a lift in the near term, but look at the United States. They don't seem to be projecting quite the same problem there. More of a levelling off, and then in 10 years' time, potentially an increase in this vital age range. That's very, very interesting and very important. Now, I'm going to share with you here a slide again by Saracen. Have a look at that light blue, very volatile line. You can see it going up and down. That is the GDP 10-year average annual growth rate all the way back to the 1960s. And it shows you, if you draw a red line through that, the average you get is 7.54%. In other words, global gross domestic product output has been around 7.5%. When you've got that kind of growth, you don't have to be much of a genius to make money. As long as you've got your money in the markets, you're more likely to make money than you won't. But look at this. This is a forecast from Saracen. They take that 10-year moving average, and that navy line, it's falling. And indeed, they're predicting it flatlining at around 3.5%. Now, they could be wrong, but they drew this before CV19, and I think there's a real possibility here that because of the swelling population, the fact that we have less and less people of working age, I think this points to a real possible outcome. The evidence that that sort of pulls through is really, really important. Have a look at this slide. Now, at first this is confusing, but bear with me. On the left, Saracen are showing how they project if we did stay with the 7.5% per year growth world, how actually those orange bars on the left, only about 18% of companies on the S&P 500, which is the US or one of the US stock exchanges, they fail, so they get falling profits. But most importantly, a far greater percentage of companies get rising profits. And so it's pretty easy to make money in that environment. But slide it across to the right. Take yourself into a 3.5% growth world, and oh my goodness, things look different. Everything moves here to the left, and 28% of companies now on the S&P 500 now have falling profits. What's really, really concerning is that about 50% of companies on the S&P 500 just stand still. They don't make any profits. They just literally stand still. And in that environment, my suggestion is people who just think they can just kind of track the markets are going to get badly caught out. I believe, and Saracens certainly argue here, that active fund management is going to become far, far more vital as we go forward, because there is money to be made, folks. That's the good news. But the bad news is it's a little bit harder to make. So I want to finish my slides today by looking at the cases for America and the UK. Now, in the UK, we have a saying, when you hear people, they say, oh, only in Britain. And we say it kind of negatively. What's really interesting is in America, they'll say, only in America, as if it's a good thing. And this is really the best way I can illustrate how I believe America will come out of this. And I believe perhaps we need to take a little bit of a leaf from their books. So, what's America got on their side? They've got a very positive culture in regards to failure. So, for businesses to fail is not the end of the world, and they've got a very strong venture capital culture. In other words, they're happy to invest money into startups and see if it works and give something a try. They love as well kind of that localism, that buying American goods and brands, and that's very, very important for them, and I think that stands them in good stead. They also have those demographic advantages that I've already pointed to. They look better going forward, in 10 years' time. If those projections are to be believed, they're not going to have the problems that most of the rest of the world is going to have. They've also got control of markets through the major players. And if we are indeed into some kind of Cold War, tech enemy stance between America and China, I only see one winner here. You've got a country here that has control of major players like Google, Microsoft, Apple, Amazon, and so on. And finally, certainly under Mr. Trump, you've got freedom for markets, low regulation, and very, very low government interference. So that looks good for America. I know they're in a bit of a spot right now, but if they can get this pandemic under control, my money's still on America a little bit. But what about the UK? Well, I'm a kind of glass half full guy. That's just how I look at life. I think that in the UK we need to take that approach. I think if we can do that, we have got a lot more on our side than people realise. The big thing we've got on our side is that back in 2016, the world was shocked by the Brexit result. However, what that meant was shares in UK companies were sold off, and UK companies are still quite cheap by valuation standards. So what that means is you don't need a huge lift to see UK funds and UK stocks potentially doing quite well. As we potentially look at the wrapping up of full-on globalization for a while, we can look at more of a buying local culture. Now, if I was Mr. Johnson right now, I would be advocating buy British. Focus on local. Try and support your local, manufacturers. Build here. I think it's a crucial recipe for success. Also, our unemployment numbers, they're going to be catastrophic, okay? We're going to be in for a really, really tough month, I believe, or two, where we're going to hear a lot of bad headlines. But I believe that a lot of very talented people are going to be out of jobs for a short period of time and moved into the winners, because there will be winning businesses in all of this. You know, if you're making hand sanitizers right now, you're in good shape. If you're making products that do very well in this kind of half semi-lockdown culture, you're going to do very, very well. And so there are going to be winners. And I think we'll see a lot of British businesses that have worked out a way around this, taking on talented people and really leveraging up their success. Also Brexit, you know, I can't get away without mentioning it, just to say that actually we are starting to see some certainty. The first thing I wrote on this subject back in 2016, when I predicted that we would leave, what I said was markets are not political. Markets just want certainty. And it's the certainty of knowing that we're definitely leaving, and really it's about wondering whether we get a deal now, but by next year I think we'll be in a much clearer position. And so I've put here what a difference a year makes. Now I hope and I think that by next year's Masterclass we could be looking at quite a good picture for the UK. And I know that sounds a little bit contrarian right now, but honestly, a year is a long time. So bear with me here. I think the UK is a half full glass and potentially filling. So that brings me actually to the end of our first session. Well done, you've made it. Now, if you've got any questions, this could be the session that you really want to ask questions on. Can you email me now, and I will endeavour to answer you either during my wrap-up video at the end of this morning, or if we get too many questions, I'll email you a response. Now, it's time for our first hidden quiz question. This is a chance for you to win one of our locally crafted face masks from Celtic Quest. So, are you ready to send me an email with an answer? The first one sending me the correct answer wins a face mask, and if we get a runner-up as well, which I'm sure we will, I'm sure we can send chocolate. So, are you ready? Fingers on the buttons. Here's the question. How many dollars did the Fed pump into the US economy? There you are, seeing if you were listening. Was it A, $750 billion, B, $2.9 trillion, or C, $7.4 trillion? A, B, or C? Folks, email me. First one in wins. Is it A, B, or C? Go for it. That wraps up our session. I've got my usual warnings there for you to read. Next up, I'm going to be interviewing the head of research for legendary fund house EdenTree. I'm so excited about this. We're going to be trying to find out more from Neville about the way that they do things, and I'll be sharing this all with you via a video link. Now that link will actually be like an audio link. It should be fantastic for you to just see some of the slides they've put together for you. So you just need to close this link now and click on the next one on your email that I've already sent you today, and sit back and enjoy. Thank you very much, and I hope you're having fun so far.